Hello and welcome to the i3 Insights podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. As you probably know, we love our disclaimers in this industry, so here's ours. The following recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to the second episode of the i3 Insights podcast. Today we have two very interesting guests. We have Chemay and Sahil Kaura. They are co-founders of Clover, an Australian-based robo-adviser that's offering a variety of innovative solutions to people who might not otherwise be able to invest in traditional investment products. So Harry and Sahil, welcome to the podcast.
Thank you so much for having us, Daniel.
Thank you.
Well, I guess a good place to start is finding out a little bit more about you and how you came to be at Clover and where the idea for Clover came from.
Sure, so perhaps I'll field that one. I have a background both across retail and institutional advice. So I actually started off about 20 years ago as a paraplanner with the then KPMG Financial Services. It was subsequently sold. But I spent about 10 years in wealth management, predominantly dealing with two sorts of clients. I dealt with very, very high net worth clients whose advice was really structured around tax-based advice and portfolios that were essentially created for them, bespoke portfolios. And then I dealt with other clients in other roles that were of more modest means, and these were clients that often would struggle to meet their financial goals because they started the journey, the advice journey, too late. And that always stuck with me even as I transitioned across to an institutional role, which is where I met my co-founder Sahil Kaura when I joined Mercer in 2007. And it certainly was I guess, it was very interesting to see those two different worlds. I'd come from a retail world, and I was now very much in the institutional world, providing advice to large client superannuation funds, endowments, and the like, and to see the differences in the total cost structures between the two worlds, which I felt was interesting insofar as retail clients were clearly paying substantially higher fees than institutional clients. Scale notwithstanding, I felt that there were some issues that could be overcome to bring some of those costs benefits that the institutional clients benefited from and retail clients couldn't get access to. So I guess the journey for Clover was probably conceived even back then in 2007, 2008, as I had already by that stage become quite adhered to the idea of low-cost passive investing. I was on my own personal account using exchange-traded funds. I had already started to recommend them to clients with ETFs, having really only arrived in Australia in 2003, some 10 years after they were first launched on the NYSE. So the whole concept, I guess, of robo-advice, in a nutshell, if you want a definition of robo-advice, it's the provision of financial advice and or investment management services online with little to no human involvement, with the resultant investment recommendations effectively based on mathematical rules or algorithms. And by doing that, the idea is that we open up advice and investment management services to a whole new cohort of investors and potentially a whole new generation of investors who ideally start the journey sooner. One of the things that has always concerned me is that Australians simply start engaging with their finances and their financial health way too late. If you're leaving it till your mid-40s, which tends to be when most Australians first engage truly with their superannuation funds, you've left 2 decades on the table. And by engaging earlier, we hope that Australians will effectively be in a far better position when they truly start engaging with their retirement thinking at the age of, in their mid-40s, and therefore be better placed for a comfortable retirement.
Sahil, what's your story?
So prior to Clover, I'd pretty much spent all my time on the institutional world. I started my career as an actuarial analyst, consulting to superannuation funds on the defined benefit liabilities, pension valuations, and from there I moved into investment consulting at Mercer. That's where I worked with Harry and advising large superannuation funds and insurance companies on matters such as portfolio construction, asset class research, and manager selection. And as so you grow through your career, you start thinking about the bigger picture and the impact your day-to-day activities have within the industry and beyond. And for the first 5 to 7 years of my career, I didn't really pay much attention to sort of the retail financial world, so to speak. It was something which just sort of happens on the side. But as you gain more experience and better understanding, I started noticing that in the institutional world, we have a lot of very smart people that are doing some really good work in the world of investments, using really strong academic rigor and having the best of the intentions in creating some really good products. By the time they get to the retail end, a lot of times layers of fees get stacked, and the same product which is available to institutional investors for the sake of example, let's say 50 basis points, is 3 times more expensive. And we all know the impact of fees on investments over the longer term. And in today's day and age, there's absolutely no reason for that to be happening. Maybe perhaps 2 decades ago, when administration platforms with heavy admin burden were required, a lot of paper pushing, perhaps those distribution platforms are at a place. But in today's day and age, when digital distribution effectively can provide the same product to the end user with very little cost and much greater transparency, there's no reason for it to not to be happening in Australia. It started happening globally, especially in the US, about 4 to 5 years ago before we launched Clover. So really bringing that institutional quality asset management and portfolio construction direct to the end user in a much more transparent, much more accessible, and at a significantly lower cost is sort of what drives me on a day-to-day basis in building Clover.
So it sounds like you both came to this realization that there were a lot of inefficiencies in the way that financial advice and investment products were distributed. And by inefficiencies, I mean there's a lot of people clipping the ticket on the way through. And clearly you thought there had to be a better way to do this. That's still quite different to taking the leap of leaving steady employment with a large, well-known firm and going out on your own, doing something that's quite new in Australia, although it had been done overseas. What sort of prompted you to finally take that leap, and how did you go about organising yourselves to do it?
Well, look, we all have always been cognizant of developments in the US. I've always felt that developments there sort of lead developments in Australia by 4 to 5 years. And we certainly saw the move towards digital-based advice. It should be said, however, Daniel, that a lot of people, denigrate robo-advice. In many ways, that term itself is a pejorative term, but the concept of digital-based advice has been around for a lot longer than many people realize. Many people don't realize that actually the founding robo-adviser in the US financial engines was established in 1996 as an institutional first product dealing with corporate 401k plans, and it was co-founded by none other than Nobel Prize winning economist William Sharpe of CAPM fame. So the concept that it's new from the left field is not fair. So we were very comfortable in taking, that leap of faith, as you so put it. By sort of 2014, we had kind of looked at the landscape. We knew that robo-advice would come to Australia, had to come to Australia, because it was just going to be an obvious global trend. And I guess to date we have been proven right. We certainly aren't the only robo-advice provider in Australia. There are others that have launched around the same time as us and subsequent to us. But the application of robo-advice is nascent in our view. It's just going to get so much bigger. And, when we look at I guess, the stats, once again, we look to the US. A.T. Kearney, the consulting firm, did some numbers and has a robo-advice model that they run. I think about a year and a half, 2 years ago, they released figures that suggest that the total market for robo-advice by the year 2020 could be upwards of $2 trillion in the US, and that's just really the start of the global movement towards online algorithmic-based robo-advice.
Very similar motivations as Harry. I had actually completed my MBA part-time while working in institutional investments, and usually, as they joke, that an MBA can be quite a bit of a catalyst for a change at times. So I was sort of thinking as to in which direction I want to take my career in the world of institutional investments. And in big firms, you no doubt get to do some really exciting work, but at the same time, the institutional burden of processes, policies in big firms can be quite overwhelming. And sort of the opportunity to build a really exciting product, getting it into the hands of the end user directly, and sort of watch it grow was just too tempting to sort of not jump in. So when Harry was talking about sort of this idea at a very early stage about robo-advice, it instantly resonated, and as Harry mentioned, it's nothing new really. I mean, in the institutional world, you will have a team of analysts or portfolio managers building optimizers, using factor risk models, and the same models essentially, when packaged together and the workflow is improved and sort of automated to a degree, you essentially call it robo-advice. So we're using the exact same models and methodologies to build portfolios, what I did back in the institutional world. So there's nothing new in that sense. It's really using technology to improve the workflows significantly, to increase the transparency, and also the key thing being the distribution. That's really the new bit. So yeah, it's the opportunity to sort of do something which has a really good impact, and as Harry's said plenty of times, to do well while doing good. That's too good an opportunity to not take it seriously.
One of the things that I remember in institutional investment, particularly in pension funds, was there's this very strong belief that a large part of the value add that pension funds, particularly industry funds, had was that they know their members, they're close to their membership, whether it be because they represent members in a certain industry. And at the same time, there was always this struggle to increase engagement with members. It was very hard sometimes to know a lot about members, and most of the products that you were offering to a member were default products, sort of a one-size-fits-all investment. And one of the things that strikes me about robo-advice is that the technology allows you a greater degree of customization and a greater opportunity to learn about your members based on how they interact with your product offering. What things have you learned from your clients, or how do you incorporate the interaction that you have with them in making your advice and your product better?
Well, it's an interesting question you pose, and as a starting point, I fully agree with you, Daniel, in terms of engagement. There's this psychological concept, I guess, called present bias or hyperbolic discounting, as they technically call it, where it's really, really hard to think about your future self, and you tend to focus on the here and now and I guess what's salient. So it's been a problem. It's been a problem for the industry, the superannuation industry in Australia. It effectively works because it is a nudge, right? We have this compulsory 9.5%, hopefully one day going to 12%. But the idea is that you get funded even if you do nothing. And most Australians, therefore, don't do much until that point where superannuation is salient to them. It's actually a pot of money that means something material. And from what I've seen in my former life as a financial planner, it was a figure sort of north of what your car was worth and south of what your house was worth, but it was a decent figure, and it probably occurred sometime in your mid-40s. Now that therefore it's the issue of how do you engage members, and it's terribly difficult for super funds. I get that. How do you engage the disengaged? And I guess that's where Robo-adviser, I feel, has a role to play. We certainly purposely built Clover to engage with those that currently weren't engaging with their finances. And that's fairly typically the younger cohort. You might call them Gen X or Gen Y or millennials, but they are people in their 20s and 30s who haven't quite built up that superannuation nest egg, but they are interested in their finances. They're interested in getting into the housing market. They're interested in how they can advance themselves relative to their peers and also relative to the previous generations. We find that they engage very differently, and we know of their behaviors because, well, effectively we are able to look at when they engage with us, how they engage with us, the pages they visit, the journey they take before they come to Clover. We have all that data, and what is truly interesting, I guess, about Gen Y is the way they engage with their finances and the time they choose to do it. So when I was a financial planner, you made an appointment with a client. That client traveled potentially across town to a physical office where you were located and went through quite a boring, let's face it, unengaging process to ultimately come away with a very intimidating paper-based document. Now most of our clients essentially engage with us either after work during the week, and it's fairly typically between the hours of about 7 and midnight, or on weekends. And that is the way Australians now want to engage with their providers, whether it's financial or otherwise. I kind of say that 9 p.m. is the new 9 a.m. And in the busy lives that we all lead in this really busy world, you have to be able to engage with your members or your clients 24/7 in a manner of their choosing and at a time of their choosing. And that's where I think Robo-adviser really delivers in spades.
Since launching our beta to the public in December last year, there have been some really interesting learnings, and even prior to that when we were in private beta. Millennials, they do understand the value of the data, and they are also very well aware that it's their data. They don't mind it providing it to you, but what they expect is value in return. So, especially sort of taking Clover's example, we over the last 6 to 8 months we've done a lot of work in sort of putting in the basic plumbing in place to collect all that information, being really transparent with our users as to we're collecting it now. Over time, this database will become more and more valuable. Some of the early touch points we've created where we provide value is around essentially incentivizing the right kind of behavior when it comes to investments, especially long-term investments. So a lot of Clover users are essentially first-time investors. So that initial excitement of funding your account, seeing it getting invested, and then logging in, and especially given that you can log in with a click of a button, logging in multiple times in a day to kind of see what's happening with the portfolio, that can create behaviors which are at odds with what long-term investing or the right way to invest is. So based on how a user engages with their account in the early days, based on what the portfolio performance is, we create customized messages and customized emails. And they go both ways. So markets have been relatively good in terms of performance over the last 12 months in sort of major asset classes. So a lot of our users sort of create their account and see a return over the month which is sort of greater than what our long-term expectations and averages are, and they get quite excited. And messaging even there and then to sort of educate them that looking at performance over 1 month, 6 months, or 12 months is interesting, but it shouldn't drive your behavior. So if you're seeing your portfolio perform well, don't get too excited and don't change your plan, what we originally sort of put in plan for you, and equally vice versa. And this is more important for, when markets are down, and especially if you've just funded your account, the chances that you might have negative performance and a portfolio balance which is below what you initially started with, or high, customized messaging at that point. And that's yielded, even in this short span of time, that's yielded really good results in incentivizing the right behaviors. And especially when you start with a smaller account balance in your early 20s, and say, for example, you're saving for a home deposit, which is $120,000, which you want to get to in 5 years' time. In the early years, it's the contributions which will have the biggest impact on your outcomes, and that plus 1 or 2% return difference, if that starts driving behavior which is not in line with that long-term plan, that can lead to be sort of a much worse outcome. So sort of creating customized messaging, creating analytics which provide users with that information at the right time is something which is already proving to be very powerful. And as we collect more and more data and we push them through our machine learning algorithms which we're putting in place, that will become a lot more powerful.
I think you raised some really good points there, Sahil. My background is in psychology, and one of the things that really interests me about robo-advice is that it can be a delivery mechanism, as you point out, to nudge people at the right time towards what's in their long-term interest. And because eventually you get to know their patterns of usage and what they're doing with the robo-advisor, you can time those interventions and make sure that they're appropriate. And it reminds me of another idea, this idea of a teachable moment, that sometimes you're much more able to influence people's behavior if you give them the right information at the right time. And I think that's something that the critics of robo-advice miss, because they think it's just formulaic, and they don't understand that it's actually also learning how the customer's behaving and helping to provide that advice at the right time. So I think that's something really exciting and worth acknowledging. A couple of other specific things about robo-advice that I'd like to get your opinion on. One of the things that default products have is that they pretty much assume everybody has the same risk tolerance and the same long-term objectives and the same starting point. And robo-advice doesn't do that. There's obviously a process where you get to know a little bit about your clients right up front. How do you think that changes the interaction with the client? That exchange of information and creating a portfolio that suits them?
I guess that's the key difference, right? It's a challenge for super funds insofar as they have to have a default product, my super product, if you will, an investment option to meet, I guess, a particular investment objective, and it's all comers. Whoever wants to be in that option or lands up in that option by default gets that experience. The difference with robo-advice is because of the advice component, the fact that we can provide personal financial advice, and to do that we need to know, the client's relevant personal circumstances, and the key driver for robo-advice, certainly in this version of robo-advice, what I call Robo 1.0, it is the risk tolerance or risk aversion, whichever way you want to say it. So it is about finding enough about the individual, and we put a particular emphasis on sort of downside risk, right? Because we totally realize that we are dealing oftentimes with novice investors, and they may not have experienced a downturn. Let's face it, a lot of our clients certainly weren't investors during the GFC. Their parents might have been, but they certainly weren't, so we're very cognizant that they might not have experienced a 20 or 25% drawdown. So we need to tease that out. At what point will they effectively run for the hills, cash in and go to and sit in cash, the way many investors did right about in early 2009, just as markets bottomed. So we tease that out. We ask them a sufficient amount of questions to give us a sense of which portfolio might suit them best and what their risk and return trade-offs are. And by doing that, I guess not everyone gets the same portfolio. That's the whole point of robo-advice, that everyone should get a portfolio that best matches both their risk tolerance and also their investment objectives and time horizon.
Yeah, the great thing about digital platforms like Clover is, especially when it comes to risk assessment, is that we not only learn from what our users tell us via the means of a risk questionnaire, but we also learn from their behavior. So we have a risk questionnaire which tests for risk appetite, and as Harry mentioned, there's focus on downside risk and asking them questions, sort of asking the same thing a few different ways to get an understanding of what their risk appetite is, but then assessing that against the behavior we observe over time, and that whether the risk tolerance they're displaying is that in line with sort of what they indicated via the means of a sort of risk appetite at the start. So for example, if markets are more volatile, is there a change in the contribution profile which they've indicated? What kind of articles are they reading on our blog or within our FAQ section? We have an automated chat set up, so what kind of questions are we getting via that means? And collecting all that data and sort of putting in the infrastructure in place so that we can actually start assessing what is the efficacy of the risk questionnaire, and over time basically refining it, improving it, and sort of developing, over the long run, essentially two scores which test against each other. One is really derived from the inputs from the user, and the other is derived from sort of the observed behavior, to improve the efficiency of the model.
I think another thing that we need to be cognizant of with Robo-adviser is also the level of education that is needed to support a good Robo-adviser platform. Daniel, you mentioned before, the sort of concept of I guess, just-in-time delivery of advice. Richard Taylor himself has spoken about that. The ability to deliver a piece of knowledge or use that teachable moment to make a client aware of what they should or should not be thinking of at that particular moment. And I think that's one of the real powerful potentials. I think it's vastly untapped. We're on that journey, but I think we can all do better as an industry, and specifically robo-advisors, to give clients the information they need at the right time and in the right context to allow for better decision making.
I know one of the other criticisms that I've heard people make about robo-advice that I'd like to quickly address before we move on to other things is that the investment options themselves are fairly basic. They're often passive and ETF based and fairly plain vanilla. How would you answer that? Because from what I'm hearing from the conversation, the value add isn't so much on the investment side, it's more on the getting to know the client and fitting the client's needs more and meeting their objectives. Would you say it's a fair summary of it, or?
Yes, certainly, and even sort of on the investments question, I would say that if I was giving advice to a friend or a family member, and this wasn't digital, and given the typical profile of a Clover user we have, and if they had a similar sort of circumstantial profile at a high level, and they asked me, I'll still recommend the exact same portfolio using ETFs for a couple of reasons. One is essentially having worked at a global asset consulting firm with one of the biggest databases on active managers and their performance over time, knowing that after taking fees and taxes into account, active management over a longer period of time rarely sort of provides value in terms of manager selection. So that's one big reason. Secondly, the issue of accessibility. If I can't access strategies which I rate really highly until I've built a portfolio which is worth $200,000, that doesn't mean that I shouldn't be able to invest in high quality portfolios, and ETFs are a great way of accessing really good, robust asset allocation strategies using passive, low cost and transparent instruments. So, in the room, we'll all know that asset allocation explains 90% of the variability of return. So getting that bit right early on in the life, rather than sort of coming into your working life and hearing from your mates about the next junior mining specky and learning the hard way. I think there's a lot of value in providing robust asset allocation solutions early on in the life.
And I think to sort of pick up from Sahil's point, I think as an industry, we in finance tend to get carried away with the beauty of models and the complexity of our portfolios. But to be fair, sometimes simplicity is all that is needed. Our clients do get access to the equity risk premium, but they're just getting it through a really simple beta harvesting product. They get access to duration, they have cash in their portfolios. We have the basic building blocks of a diversified portfolio, and we can bring that to an individual at a far lower level than is traditionally available. As a former financial planner, the economics of running a financial planning firm just didn't work for me. I could not take on a client with less than $250,000. And to be fair, really, it was a $500,000 entry ticket. Now, why should a whole cohort of Australians, irrespective of age, be denied the basics of sound fundamental portfolio construction just because they don't have $250,000 or $500,000? Why should the only option available to them be a single stock or some hot sector that they've heard about from their mates? I think we as an industry have some ways to catch up here. And I take great heart from the likes of David Swenson at Yale, who has on record gone on about complexity and the over complexity that we tend to engineer into portfolios just for the sake of it, oftentimes as much to stroke our own egos as anything else, when oftentimes a simpler, more transparent solution is really all that is required. We certainly do feel that simplicity is greatly underrated in finance in this day and age.
One last question. What's next for Clover? What are you guys working on?
The user experience for Robo-adviser will change away from what currently is a user sitting at a keyboard or looking at their smartphone and typing in some inputs from which we drive our outputs. Now, we probably see that in 4 years' time, 5 years' time, certainly no more than 10 years' time, that interaction may very well have moved beyond that to something that is more sort of chatbot driven, and possibly even beyond chatbot driven to be more voice driven. So the concept of interacting with your advisor, whether it's your financial institution or your individual financial advisor, through a mechanism like Alexa or Siri is well within the bounds of possibility. Obviously, the issue here is that the regulatory environment needs to catch up in some sense to what is technologically capable, but we don't see any reason why in a few years' time you might not put the keys down when you get home from work and say, hey Alexa, how's my portfolio going this evening, and are there any issues that I need to be aware of in terms of me hitting my goal to whatever that goal might be. Head off for a family holiday in 5 years' time to Disneyland. We really see the emergence of that sort of technology and AI, to be fair, elements of artificial intelligence as being the next logical step for robo-advice.
Well, Harry, Sahil, thank you very much for taking the time to talk with i3 Insights. We appreciate your insights into what's happening with robo-advice, and we wish you well in your endeavours.
Thank you, Daniel.
Thank you for listening to the i3 Insights podcast. For more information, please visit our website at www.i3-invest.com. Thank you.